A lot of people have been asking about how uh, to hedge with futures or sizing your hedging position if you're using SQQQ or something else. So I wanted to show everyone the steps that you need to go through, at least on the Thinkorswim platform. And I don't know whether other platforms have these same tools, but the principles are going to be the same. So this is a simulated account. I put a bunch of stocks in. Most of these, I think, except for Kinsale, I think I own all of these. So it's very similar to what I have right now. I don't have QQQ, but I do have TQQQ in my portfolio. So it's $100,000 portfolio. It's, I guess I'm probably up $125 on it since making it yesterday. So that's, I guess, good. But anyhow, so if you've got a portfolio like this, and this is a portfolio that is very Nasdaq focused, and that's why I would be focused on using something that tracks the Nasdaq to hedge it with it. You don't want to short the S&P or buy puts on the S&P, because we've seen so many days where the Nasdaq has been getting killed and the S&P is flat or up. So that hedge is not going to work for you. So whatever your portfolio, looks like, take a look and say, ask yourself, does this follow the Nasdaq? Does it follow the S&P? Does it follow something else? But it's, if you're investing in growth stocks, it's mainly going to be in the S&P. I mean, the Nasdaq, excuse me. Okay, so we've got this portfolio. We're getting nervous about the market. So let's go to the monitor with all your positions. And the first step is there's a thing here called beta weighting. So you would click it on. And since I use futures, I'm going to call up one of the futures contracts. Given the size of this account, I'm going to use the micro mini futures, which is /MNQ. And you enter that in there. Now, the thing you need to do is you've got to go over here and add something called delta. And then that tells you, move it over there, hit OK. And now we get the delta column right there. And it takes all the deltas of each individual stock, adds them up. And what this is telling you is that this stock, this portfolio compared to the NASDAQ is, if the NASDAQ is moving higher, this portfolio is going to increase more than the NASDAQ. So, and again, delta is something that everyone is familiar with if you trade options. The idea is the same, but these deltas are not the same deltas. These are whatever index or stock that you put in here, the deltas are going to change. So again, look at this. I'll put in SPY, the S&P, and watch the deltas numbers. They change dramatically, completely different, because these stocks absolutely kill the S&P. That's why the delta is 345 here, the total delta, especially lately. And it tells you also that this is not a portfolio that you would want to try to use the S&P to hedge with. So we know that these are, mainly NASDAQ stocks that are leading the NASDAQ. So we'll stick with a NASDAQ instrument. So this is the futures. I like the futures because it doesn't really take much margin buying power to use it. If you're going to use SQQQ or something like that, that becomes a problem, especially if you're fully invested or even on margin. It's tough to get enough exposure to truly hedge your whole account. So at this point, we're looking at MNNQ, and so the delta comes down to 8.85. So here's a quick little explainer about the futures contracts. The micro mini, and this is actually based on NDX, the Nasdaq 100 index. And so while the futures, while MNQ tracks this index, it actually gives you double the exposure. So it's like if this one is right now, right around 11,000. And when you buy MNQ, you would actually be getting $20,000 of exposure, or $22,000 of exposure to the NASDAQ. Or if you're shorting it, you would be double the NASDAQ. If you buy N/NQ, which is the, I guess, the mini contract, you got the micro mini and the mini, and mini me fits in there somewhere, but I'm not sure. So this one is 20 times the NASDAQ. And this is why I've said before, futures, they're very powerful as a hedging tool, but if you're going to trade them as position trades, you have to be really, really careful, because this is 20 times the NASDAQ. So at 11,000, you're talking $220,000 of market exposure of the NASDAQ with one contract. So be very, very careful. Make sure, talk to the whatever brokerage you're working with, know exactly how to use them, understand the risk, because if you make a mistake and you're net long with some of these, if you're not on top of it, you can take devastating losses if you're not really paying attention. So I don't trade futures. I only use them for hedging.
And maybe do it with a paper trading account first to start.
Absolutely. Just want to let everyone know that there's a lot of the leverage on these is amazing. Okay, so back to our delta. We're at 8.8 right here, and so to get it to almost even, we're going to have to buy between 4 and 5 contracts of MNQ. So let's go back to the chart. We put in MNQ. Okay. And since we're hedging, we're going to sell 4 contracts. And we'll make this a market order. Selling 4 to open. Done. Now let's go back to our portfolio. And I need to move this back in here because I had it in there. Okay. So now look at our delta. It's -8. So we have 4 contracts times 2. That gets us a -8. We're short. That makes our overall exposure to the market theoretically 0.83. So we're slightly long right now. So at this point, let's say the market is crashing, you'd be looking at how your liquidity, your account value is changing as the market changes. And so if the market is falling and this number is still falling, you're gonna, and it's too much for you, then you could add another contract. And let's say we'll do that. We're gonna sell 1 to open, hit that. It's so easy to trade these, right? Go back to the monitor. Now we're net short on the market. And again, this is theoretical. Based on 5 years of trading, this is how these stocks trade against the NASDAQ. It can change a lot. And so you would have to just see how's it acting. I'll tell you, a lot of times, especially when the market is really selling off, I might be at a -20. So really theoretically net short, and I'm still maybe losing a little money versus the market. So things change. If Tesla is having a really, terrible down day, that could have a big effect because it, will have a big effect on your market. So this kind of gets you in the ballpark, and then you have to watch it and decide how are you going to make the adjust it slightly. If you have a bigger account, it becomes actually pretty easy, because what you do is you use NQ, and that gets you close to where you want to be, and then you can use MNQ to really dial it in to the point where you are, like yesterday, I was taking MNQ on and off just to kind of stay with the market. When the market started rising, it's like, oh, well, I don't want to be net short. I'll take off one here. And so I was making a little money on the way up and sometimes making a little money on the way down. But there are plenty of days where it's really hard to dial in, and you might be losing on both sides, but you're not going to be way off. So essentially, this is how it works. For some reason on this, when you're doing paper trading, if you were to put in SQQQ, it doesn't, the delta doesn't show up. So I'm not sure why it is. It does show on the actual account, like TQQQ is, well, it's going to be 3 times. We can see with QQQ, if we put that in there, there's 38 shares and it's 3.15. So if you actually, I think if you divide 3 into 30 or 38 by 3, you're going to come out with 1, which makes sense that the Qs more or less follow these indexes. And it's not quite perfect, but it's pretty close. But you could do this in the same way. Let's say you take SQQQ and you could figure out where it would come, where the delta would come down to. And essentially you want to try to get to 0, and then you're in the ballpark. And again, the way I see a question, how do I decide how many contracts of this to buy? You look at your delta, and whatever that delta is, divide by 2, and that will tell you the number of M and Q contracts you would need. If you put in NQ, the delta on NQ is 20, and so if your delta is like 80 or something, or 100, you would buy 4 or 5 contracts to offset that. So that's the whole element of how this works. And again, someone's asking, what is delta? How do you figure it? To go back to this again, you need to add the delta column to your set of factors there in your monitor. Once you get that, that's just telling you whatever index you put here to beta weight your portfolio against, it will calculate how much your stocks move in relation to that underlying index. And so a couple of these stocks actually are, when it comes to the Nasdaq, longer term have underperformed the Nasdaq, whereas NVIDIA has outperformed, Tesla has outperformed. And again, what's happening today may not really be indicative of what's happened over the past few years. So again, that's why you have to play around with things. And someone's saying, can you use SQQQ? And again, the problem, and it's unfortunate, on the paper trading side, when you put in SQQ, the deltas aren't available. And I know that at least with TQQ, I've got a delta on it in my own account. So SQQ should have the same one as well. So in a real account, you would do the same thing. If you wanted to use SQQ, you would just plug it in here, see what the deltas are. And this is going to be, triple the Nasdaq. there are other tools you can use, and you'll have to talk to Thinkorswim to show you how to access that. It's kind of convoluted, but you can figure out exactly how much you're going to need. In general, a good starting place is if you have an account like this, half of your account value. So if you're 100%, I'm sorry, if you're $100,000 long in the market, you'd have to buy $50,000 of SQQQ to start. However, in a lot of margin accounts, they don't, because it is a leverage fund, you probably can't buy it if you're already fully invested. Not enough to completely offset your account. So again, a reason why I've switched to futures, it just became much easier and much easier to really dial in. So, and someone's asking, can you hedge in an IRA using futures? I don't think you can trade futures in an IRA. So with that, I would, if you have room to buy, you could hedge by buying some SQQQ, but the other thing is just go ahead and sell. There's no tax consequences. Just lower your exposure to the point where you feel comfortable. Say if you're thinking of doing this, at least at Thinkorswim, they've got a great team on the futures desk, and they will walk you through all the different tools, and you can analyze the trade before you put it in here to make sure you're in the ballpark. But that's basically how you do it. And again,
there's probably an extra level of account that you need, right? In terms of
you would have to get approved for a futures account. So it's like applying for an options account, and it's a little more involved because again, the leverage involved here is tremendous, and
it cuts both ways.
The option, I don't recall, and basically your option buying power is how much you can spend on futures contracts, but it doesn't really, it raises your margin debt, but it's not taking money out of your account necessarily, but only if you lose, then it has a big effect. So I hope that answers a lot of questions, and if you do try this, please be very careful. I think Allie's suggestion of paper trade it for a while, see how it works for you, understand that, and actually probably a great way to do it is take all the stocks that are in your current account, put them into your simulated account, and then just over the next couple of days, play around with it and see how it works, what the, and how it reacts, and how much work it does take to monitor it throughout the day and day to day, and understand, another thing that happens when the market shuts down, the futures trade almost 24 hours a day. They're closed. I don't know. There's like a downtime in the afternoon, and then they might close for an hour in the middle of the night. But you can see big swings in your account because the stocks aren't moving, but the hedge might be moving up or down. And so you need to understand that you got to sit back and know that your account might be dropping right now, but as soon as the rest of the stocks start trading, they will offset what's happening with the futures.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.